Good afternoon, ladies and gentlemen. Once again, a very warm welcome to you on Business Today Television. I am Shail Bhatnagar and we are hosting our special show, Market Guru for You, where you get to meet the finest brains on Dalal Street who've navigated markets in good times and bad times, in bullish times and bearish times, in very happy and very sad times, who've made money for their customers over an extended period and during difficult markets. We are now joined today by Mr. Manish Sonthalia. He is the Chief Investment Officer at Emkay Investment Managers, a person who's seen Dalal Street over the last 3 decades and has a very strong grasp not only on fundamentals but also on how sentiment moves and how money moves in and out of stocks. Namaste Manish ji. It's a pleasure to host you after so many months, and also at a time when probably everything is going right for Indian equities. Let's start with the very basics. How do you think is sentiment placed on Dalal Street at the moment? Let's forget the daily up and down in the market. Let's just look at how you look at Dalal Street. What are the pluses that are working in our favor at this point?
So I continue to be quite bullish on the markets as a whole. In fact, even before the election results are out, I have deployed full cash. I don't have any cash in my fund.
Okay.
But if you ask about market sentiments, markets are very polarized. There's one set of investors who believe that markets will tank irrespective of whatever the election verdict is. Once the good news is out, even if the good news is out, they will be profit taking. And there's another group of investors who believe that maybe this will become the low for the next 5 years. So I think there is a very big polarized view. My balanced view on the markets is that earnings are supportive, valuations are not very expensive, there is a long runaway for growth. So markets should be broadly inching up higher from where we are.
Fair point. Let's drill down to the fact as to where this money is deployed. Once you say you are 100% into equities, that by and large tells us what is the general direction of the markets you expect to go in. Now, break it up for us, Manishi, in terms of large caps, small caps and mid cap allocation. Where is the corpus of Emkay Investment Managers deployed?
So I would believe that bulk of our corpus is basically deployed in flexi cap, which is basically a multi cap, which is comprising of both large caps as well as mid caps. A small portion is deployed only in the mid caps, but otherwise it is a balanced proportion of allocation between large caps and mid caps. I would believe that sectorally, if you ask me, there are 3 or 4 sectors which are quite in favor as of now. Of course, everything boils down to individual stocks. But, your industrials, infra, power, PSUs, real estate, these would be some of the sectors which would be quite in limelight because these sectors are doing quite well. And but otherwise, it would be boiling down to individual stock picking.
Okay, let me just get this out of the way. As a percentage, would large caps be above 60% of your investable corpus?
I would believe it would be broadly 50-50. 50% large caps and 50% mid and small.
Large caps and 50%. Okay, now give us a sectoral flavor. We are fortunate to have you because you've seen about 4 industrial cycles and about 7 to 8 bear and bull markets. At the moment, it's the capacity, it's the capital goods space which is, really burning it up on Dalal Street. Carborundum Universal, ISAB India, Kirloskar Group. These are the old world smokestack industries which are making a comeback with a vengeance. How do you see this capital goods space led by ABB and Siemens? Is this overheated, or as you say that we may have a ride of a lifetime over the next 5 years, and when we look at these prices we'll be kicking ourselves कि उस वक्त क्यों नहीं और ऐड किया और अब तो यहाँ पर भी एक और जीरो लग गया. How do you see the cap good space?
Chiranjeev, you have been long enough in the markets and you would know that the same phenomenon we actually saw for the consumption related stocks, right? Way back in from 2010 till 2020, when everything was very, very expensive, and still, the prices just continue to go up. Sometimes it went up due to earnings and multiple expansion or valuation expansion, or sometimes it went up only because of valuation. But that was a reality. I think you turn the clock back to 2023-24, it's the same with relation to your investment related things. So capital goes, that time it was the consumption cycle, now this time around it is the investment cycle. But these are the ways of the market. When you have longevity of growth in a particular sector, then it does not boil down to near-term valuations on the stocks. It boils down to what your exit P is and how many years of growth can you see. Which again, in the case of capital good guys, capital good players, is basically a function of the order book position. So these companies would tend to move not so much on turnover and EBITDA and profit after tax, but more on account of what the order book position is like and what the bill to book is looking like. So if your order book is, let's say, 4 years of current year's turnover, there is greater amount of visibility, or whether it is 5 years or whether it is 6 years. So in the railway sector, we have some outlay of 7 lakh crores. So that is going to come to the railway sector. Then it comes down to which companies, which portion of railways will get one. So I think it is all the valuation, though does look very expensive from a near-term perspective, but I think it is the longevity of growth which gives the sanctity of elevated valuations, and I don't think that this capex cycle is going to come down in a hurry, given the promise of the government in terms of first infra capex and then the private sector capex. So there is longevity of growth, and I think the valuations will remain elevated for some time to come. I don't think there is going to be any case of a rise, a sell, but it would be more a case of buy on dips.
Okay, Manish, very, very well explained. Look at the order book position and look at how the overall sector, the government spending and the private capex is taking place, and expect at least for the medium term for these valuations and prices to remain elevated. It's one of the most simplest and one of the most wonderful explanations that I've heard over the last 6 months, and believe me, that's the reason why we have invited you, Manish ji. Let's look at the other part of the market, Manish bhai. Do you think there are some sectors where despite strong order flow, where despite very, very fantastic earnings and profit and profitability and margin expansion, yet there is froth in prices? Are there sectors where you feel a little edgy and nervous when you look at prices every day?
So I think I am not such a big bull on the FMCG space currently. I mean, all segments of the market are really doing well. But if there is one space where there is supposed to be some sort of a turnaround after many years, it's going to be FMCG space, and this on the back of expectation of a good monsoon and rural recovery, and corporates are talking about demand revival. But if you look at the earnings growth vis-a-vis, earnings growth is decent. When you look at a sectoral earnings growth of 10-12% for FMCG space is quite good. But just doesn't seem to gel with the valuation that many of these companies are still trading. Of course, you could say that the quality of earnings is very good. There's high free cash flow, and all of that basically translates into dividends, etc. But I would believe that it is more a case of some of these consumer staples related names with would be slightly out of favor in the current context of.
Manish bhai, there is this view in the market that some sort of a cyclical recovery is underway in the chemical space, as also probably the IT space. Now, within the universe that you have at MK Investment Managers, are there any new positions that you've taken into these two spaces, or maybe added to existing ones?
No, we were overweight in IT some time back, but currently we are underweight in IT. So yes, there is an expectation that again out here, the book to bill looks very promising. So which means that you have TCV signed, total contract value signed by the client, but it is not translating into revenue for the IT company. So that is basically a function of some undecisiveness when it comes to whatever is happening in the US or developed parts of the world, which is not accelerating the top line growth of company. And obviously, there is not so much on transformational deals, but that much on cost takeout deals. You become more efficient, etc. So I would believe that IT space, yes, there will be some sort of a turnaround, maybe next 2 quarters down the line. But it is again what valuations you want to pay to IT companies. I think that if you are able to get something, at something at less than 2 PEG, from the next 2 years point of view in IT companies, then only there is a margin of safety. Otherwise, not. And today, the valuations there again are not very conducive when it comes to the valuations front. Chemicals, yes, I would believe that you have seen some significant correction in specialty chemicals. There is some destocking happening in the developed parts of the world. We are nearing its end. You have one of the multinational German companies, BASF, talk about the fact that you could see the demand bottoming out. You couldn't say that revival is underway, but you could just broadly say that you could see some sort of bottoming out in the specialty chemical space. So from that point of view, if you have that extrapolation for the bulk of the specialty chemical sector, I'm not talking so much on the commodity chemicals, but specialty chemicals, I would believe that we are going to turn a corner very soon. Maybe in the next 1 or 2 quarters, these could be buying times for specialty chemicals.
So, if you haven't bought already something in the specialty chemical space, what is on your radar?
No, so we already have a few names like in our portfolio. We have Clean Science. That is one of the specialty chemical players doing a lot of capacity expansion. A 25% ROE company. This is not a recommendation, but this is something which is a part of our portfolio. Yes. And likewise, we are looking at some of these, names which have actually seen a lot of correction. So I wouldn't like to take specific names, but it's there on the radar because we believe that it's going to turn the corner soon.
Okay, Manish bhai, it just slipped my mind. Over the entire investable portfolio, of which 50 is large cap, 50 is mid cap, how many stocks do you own? And what is the sectoral distribution?
So basically, across our portfolios and across strategies, we will not have more than 25-30 stocks. So, any portfolio will not have more than 30 stocks at any given point in time. This is broadly what we believe in. We think that this gives you optimum diversification and broadly not more than 10% to begin with in any particular single name, and obviously not more than 35% in a particular sector. Broadly, this is what we follow.
Okay, and which is the highest weightage in terms of sectoral allocation?
I mean, it's got to be banking. I mean, banking, the proportion of the market today is also, 30% broadly on NSE 500. So BFSI collectively would be having the highest.
Fair point. And what are your favorites? PSU babies or old world private sector banks?
So we are also, currently underweight BFSI. We think that this whole problem of deposits. I mean, we just heard one of the largest banks in the country actually has had to raise rates by 25 to 75 basis points. So deposits is not very easy to come by, and
Yes.
liquidity is quite tight in the system, and rate cuts are some time away. We can't really expect some sort of a rate cut. In that backdrop, I think valuations are more conducive of public sector banks as opposed to private sector. I, for one, believe that unless and until you have rate cuts happen, you don't have really too much of pricing power in the banking system. Deposits are a problem. The benign credit cycle is somewhat over. You will have somewhat normalized credit cost. And NIMs at best could be flat, if not declining. Of course, many of the banks have defended their net interest margins this quarter and likely to be that way. But if there is a rise in deposit rates, again, that's going to be a pressure on margins. In that backdrop, I think there is better risk is to reward in the public sector banks as opposed to private sector banks, purely on account of valuation.
Fair point. Uh, uh, Manish bhai, this is a kind of a market which is a trending bull market where you buy relatively expensive stocks and you try and sell them at the exit PE, which is even higher. So you buy good quality stuff which is expensive, and then you sell it when it's getting to be when it gets to be more expensive. You've been a value hunter for the decades that I have known you. Do you think value lies in the eyes of the beholder, or is the market still undervalued in some industries?
See, I think what works in India is growth, right? And if you are a traditional value investor, you will look at low price to earning, low price to book, and all of that. But if you're a growth investor, there also you will find value, and that value is basically looking at what PEG you are paying. So price earnings relative to growth. So it's not saying that buy something expensive and sell something even more expensive. That is one way to put it. But I would put it this way, that if a company is growing at X, if as long as you are paying 2 PEG for or 2X in terms of PEG for that growth, or the PE multiple divided by the growth, that number is 2 or less, broadly you are safe. But once that number goes beyond 3, 3.5, I mean, it's very difficult to make money even in terms of growth stocks. So yes, as we alluded to the fact that capital goods, or let's say public sector units, or real estate, they are going through an up cycle, right? And they will exhibit some heightened growth.
Yes.
But even in that context, if the PEG, according to me, and this I have learned through decades of investing, is that in India's context, if you pay something more than 2.5, then the margin of safety goes down. We as fund managers are only looking for margin of safety. It's not that we don't like a particular sector, we hate a particular sector. It's what sector at what point in time is going to optimize the returns is basically what we look out for, and where is the biggest margin of safety. So in that sense, we think that currently the investment related cycle, stocks or sectors are likely to do much better, because that's where that pillar of the economy today is firing on all cylinders.
Absolutely. So yeah, you're of the view that there is a huge capex cycle in the pipeline as far as the Indian corporate sector is concerned, and newer and better factories, both from existing corporate groups as well as overseas players, are going to be set up in India, and therefore it makes
And even the
sense
government of India, the government of India is basically spearheading the capex cycle. First the government capex has come through infra, power, roads, defense. This is basically government led, and now the capex is expected to follow suit. because capacity utilization across industry is reaching closer to 70%.
Okay. Manish bhai, I would be failing in my duty if I don't ask you this very specific question. You've been a fan of order books, which you've just mentioned. I just want to understand, what do you think of this defense space?
Lot of growth is still ahead of us. I can tell you this, that these are monopolies. Now with not only indigenization of the entire defense budgets that we have in the country, there is a focus on Atmanirbhar, which basically means that we are going to, in a matter of time, over the years, going to produce as much as possible indigenously, but this is also going to be an engine for export. So not only would we have higher turnover and order book, but we are also going to rely on order book position from outside countries and outside corporates. So I think this sector will see heightened activity in terms of top line growth, bottom line growth, margin expansion, multiple expansion for a lot more years to come. This is not the end, or we are not at the fag end of the entire recovery in defense companies.
Okay. Without saying a lot, you've revealed what is there in the pipeline and what your thought processes are on this. I've always believed that defensive stocks have always been on the offensive as far as Indian equities is concerned over the last 3 years, and it's still not done yet. I mean, I don't think so. We are even in the prime health of where these companies could be 5, 7, 10 years from now. Be that as it may. A couple of more questions, Manish bhai, on this blowout that is happening on the two-wheeler space, as also four-wheelers. Is aspirational India the new theme? रोटी कपड़ा और मकान वाला समय चला गया या वो अभी आएगा?
So two-wheelers today, what is happening is basically the premiumization story will play out in a big way. Why do you think Harley Davidson is so eager to come to India, or Triumph is so eager to come to India, or let's say Bajaj Auto is launching the heaviest Pulsar, or let's say an Eicher Motor is basically launching a Himalayan 450 and 650 and all of that? Because it is the premiumization aspirational quotient which is likely to play out. You exactly don't know which year it is going to be showing up in numbers, but it will play out over the next 3-4 years. And that is where the real excitement is going to be when it comes to the two-wheeler. Because that premiumization would mean that, you will see a bulk up in volumes on that segment. It's going to be a higher price product than the entry-level segment. You're going to make some superior margins. And all of the two-wheeler companies, except for one, you're trading at very reasonable valuations. So I'm much more excited on the two-wheeler space, and basically the rural recovery is still not happened. And once you have a rural recovery, the 6-8% volume growth in the two-wheeler industry, which we are currently seeing, we'll see some double-digit. And it's not only going to be the entry level, but the real India excitement or the per capita income story growth is going to play out in the premium segment, which is basically your 150cc going up to 350 and 500cc, that segment. And it's now high time. I would believe that this is overdue. This premiumization story in two-wheelers is overdue. It will play out.
And what's really more exciting is that a couple of these two-wheeler stocks are actually in the zone that Manish bhai beautifully describes. 2x price earnings.
Most of them are trading at
that is a mathematical form. Yes, exactly. That's the reason why I asked you that question. Manish bhai, my final one to you. This is a Goldilocks scenario. People like you and me have waited for decades for this kind of a market to happen in terms of participation, in terms of expansion of the corporate culture, and really the economy taking off. Deep in your mind, do you think anything can go wrong? And if yes, what?
I mean, the current government having less than 272 seats, I mean, that is going to be a big setback.
Okay.
Then it is all different sorts of permutations and combinations which will have to be worked out again, because there is going to be a discontinued policy backdrop. I think that presents the biggest risk. And we'll get to know that on 4th of June. So let's keep our fingers crossed. In the real world, never say never. There is always an element of probability somewhere down. And when you are in the markets, you keep always the black swan events, very, very much under your
Yes.
radar and at the back of your head. So with that, I think that is the real risk, one biggest risk that India faces currently.
Okay. Thank you, Manish Bhai. Just an update on my side. I have voted in North India. It's your turn in Western India to vote, and I'm sure you'll make the right choice. Thank you so much for spending the previous 30 minutes with us. It's been such a wonderful experience talking to you. And now I hope that you will be a regular on Business Today. Our best wishes to you as far as the portfolio is concerned, and I'm sure you will do immensely well, just as you've done over the last 30 years. Thank you so much for your time, sir.
Thank you, Shail. Thanks.
This, ladies and gentlemen, was Manish Sonthalia, the Chief Investment Officer at Emkay Investment Managers Limited. Thank you for watching us, and I hope you've enjoyed this show as much as I have learned from it. Stay tuned to Business Today Television. Thank you so much.
Hello and welcome. You're watching